Good morning, everybody. Welcome. Welcome to this session on where are we with stablecoins, past, present, and future. Thanks very much indeed for joining us. I'm Gerard Baker. I'm editor-at-large of the Wall Street Journal. Typically write about macroeconomics and geopolitics, but like everybody, have an interest in this phenomenon, this growth broadly of cryptocurrency, and of course, particularly what's been happening in stablecoins. Got a terrific panel here with a range of perspectives and views on this topic. Just briefly introduce them. We've got to my immediate left, Dan Katz, First Deputy Managing Director of the IMF. Next to him, Jeremy Allaire, co-founder and CEO of Circle, of course, one of the big stablecoin company. To his left, Vera Songwe, who's co-founder of the Liquidity and Sustainability Facility based in the UK, although with heavily focus on Africa, aren't you, Vera? Yeah. And on my far left, Siu Yat, co-founder of Animoca Brands based in Hong Kong. Just to set the stage, obviously, we've seen a dramatic explosion in the use of stablecoin just in the last few years. The numbers are, latest data were that $33 trillion worth of transactions in stablecoin last year. That was a 72% increase on the year before. I think over $350 billion worth of stablecoin assets now. Everybody seems to expect this growth to continue. We've had a lot of focus, interesting focus on the regulatory environment. Genius Act, of course, passed in the United States last year. Other countries also establishing a regulatory framework for dealing with stablecoin. I think, to me, the most fascinating story, we'll get into all aspects of this, but the most fascinating story to me is the question of, of what is the ultimate potential here. I know the sort of passionate, the evangelists for crypto generally see stablecoin because as the name implies, because of its stability as a real disruptor of the global payment system, representing a significant challenge to existing financial institutions, reducing friction in domestic and especially in international transactions, with all the potential, some of the people I speak to think that ultimately perhaps replacing traditional financial institutions in so many of these payment systems. Others think maybe the potential is more limited. So we'll get into all of that, and we'll get into a lot of the details. But once again, thank you all for being here. So let me start with you, Dan. We have seen, as I said, this explosion of the use of stablecoins in the last few years. What have been the main drivers of that growth?
Well, thanks, Jerry. It's great to be here. In terms of what's been the main driver for that growth, I think that's actually a helpful framing for understanding the way that the evangelists, as you put it, and also maybe you could say the reactionaries, look at it. So the $37 trillion of transaction volume, I think, is actually a little bit misleading because a lot of that transaction volume, might be trading back and forth between AI agents and various other forms of digital transactions, which may not actually be that tied to economic substance. So I generally prefer to look at what's the total volume of stablecoins that's been issued, which absolutely has been growing. But in the context of the global financial system, $300 billion is still very, very tiny. So I don't think we quite yet know where this is going. What is clear, though, is that there are both very significant potential benefits from the deployment of stablecoins, across improvements in both domestic and cross-border payments. In terms of financial inclusion, I think that's often an overlooked benefit, but a really important one. And then, of course, that's offset by potential risks, whether that's financial stability risks, so as a result of runs on particular stablecoins, or whether that's a result of payment fragmentation that could silo liquidity, or as a result of disintermediating the banking system, which I think is oftentimes the most severe risk that folks are focused on, and from an emerging markets perspective, the threat of currency substitution and very, very volatile capital flows. But it's really early days. And so I think, from the perspective of the fund and from the perspective of economic policymakers, it's important to remain balanced, to work to establish clear rules and frameworks. And we've seen a lot of progress on that front. But be very open-minded both to the benefits and the opportunities as this ecosystem starts to interact with the traditional financial system.
So, Jeremy, let me ask you, sort of almost to flip my opening question on its head about why have we seen this explosive growth. I mean, to Dan's point, okay, the transaction number is one thing, but the actual total value of stablecoins is another, 300 billion, which again, as Dan says, is a drop in the bucket, not only of total, obviously, financial assets, but actually even of crypto, of total crypto assets. So to sort of flip the question around, maybe, why haven't we seen even faster growth? Why aren't people adopting stablecoin more? And, presumably, again, from your perspective, you firmly expect them to do so, and how is that going to unfold?
Well, I mean, look, it depends on your definition of fast. We've seen USDC grow over 80% a year for multiple years straight. We saw in Q3, our most recently publicly reported quarter, we saw transaction volume in USDC grow 580% year on year. Across so many other metrics, the amount of USDC flow across blockchain networks also growing at huge growth rates. What's interesting for us, though, is this gets into the original question, which is when we think about this, really from inception, when we designed this in the first place, we think about general purpose, general architecture money for the internet. Fully reserved, very safe, fully reserved. Now we're getting prudential frameworks to provide for that safety in a digital cash instrument that can scale from a transaction that might be between one AI agent and another AI agent that needs to consume digital tokens for 25 cents, all the way up to a bond purchase that might be $1 billion bond purchase settled internationally, and everything in between. And so when I look at the use case proliferation that we're seeing, it's extraordinary. We are seeing use grow in cross-border trade settlement. We're seeing use grow in trade finance. We're seeing the biggest e-commerce platforms like Stripe and Shopify adding USDC payment acceptance in their own platforms. We're seeing the biggest remittance companies and neobanks adding USDC as a way to store value, as a savings vehicle, as a payment system capability. The biggest payments networks in the world, like Visa and Mastercard, now using USDC as an internal settlement infrastructure. The biggest asset issuers and asset managers like BlackRock and Apollo issuing private credit products on chain or other fund products on chain, where the primary way that you create and redeem these new securities is with things like USDC. And then obviously in peer-to-peer transactions, I think one of the things that I think people often mistake is there's a lot of USDC and stablecoin in general that comes in and out through these big aggregators like a Binance or a Coinbase or others, quote-unquote crypto exchanges. But what's interesting about these platforms is that, yes, people are using them for trading and investing, but they're also using them for savings. If you look at a platform like Binance with over 300 million users, 20% of their users are in Africa. Far higher penetration of users in Africa than the banking system in Africa. And people are using it primarily as a dollar substitution mechanism, as a way to store value, make peer-to-peer payments, et cetera. And so the use cases are growing in every sector of the economic system, and with the regulatory clarity, I think that's breaking out all around the world. We expect that to accelerate as well.
Well, you moved us nicely on there by talking about Africa to Vera. The vast bulk, I think it's true so far, of the stablecoin activity we've seen is obviously fiat currency backed, and in particular US dollar backed. But Vera, I know you've been particularly in Africa working on alternatives. Can you tell us how that sector of the market is growing?
Yes, no, I think, thank you very much. I want to come back to the 33 trillion number, and it's not clear to me that one needs to dismiss it just because the money velocity is increasing, because that is what 33 trillion is. It's the money velocity. Yes, the base is 300 billion, which is already a big number when you talk about how quickly it has grown. But in Africa in particular, I think there are four, positive use cases for it, which is one of the reasons why it's growing so fast. The first one is just about transaction cost and arbitrage. And so far, for the last, I would say, 15 years, one constant agenda item on the G20 has been reduce the cost of remittance transfers. Remittances are more important to Africa than aid has been, and actually cumulatively over the last 3 years, remittances have tripled compared to overall development assistance. So this is how important it is. However, for every dollar that is sent out onto the continent, you have 0.06. So let's say if it's $100, $6 of payments cost in transactions, which is quite expensive. In addition to that, if you're transacting over the weekend, then you have to wait for Monday, right? So if you're a small business transactions person, those 3 or 4 days, sometimes on the continent, is actually 5 days in terms of sending resources. With stable coins, it takes minutes and it costs $1. So one of the beautiful things about the Genius Act is really that, it has now created a regulatory framework for stable coins. But the big, beautiful budget was going to start taxing remittances by $5. So you're going to add already 6%, you're going to add another 5%. With stablecoin, you can do that. The second thing that is important for stablecoin is, of course, the hedge against the inflation in many of our countries. Post-COVID, we have about 12 to 15 African countries where inflation was above 20%. And so essentially, the fastest way to poverty increases is inflation. And so what you want to do is, what stablecoin is doing is providing people with a safety net, a safe account. 6.5 billion people globally do not have, 1.5 billion people globally do not have access to a bank account. 650 million people on the African continent. With a smartphone, you have access to stablecoin, so you can actually save in a currency that is not exposed to the fluctuations of inflation and making you poorer. So that's another big contribution of the stablecoin.
Can you give us a sense of what the take-up is so far in Africa? I'm assuming
you have a lot of take-up in the countries where inflation.
Right.
So and I think stablecoin also, in some sense, is almost a directional way of looking at monetary policy and restrictions on capital controls. Where you have higher capital controls, any country that has higher capital controls has stablecoin use quite high. So we have the 3 biggest stablecoin users on the continent today are Egypt, Nigeria, Ethiopia, to some extent South Africa. But South Africa is because SME businesses are using it. And this is the last point that I was going to make, is actually also small and medium enterprises. The large bulk of stablecoin use on the continent is below $1 million, which means it's mostly SMEs transacting on it. So it's a huge inclusion and financial inclusion, as you said, too.
So what's your sense of both the immediate potential, the short-term potential of the growth in stablecoin and ultimate potential? I mean, where does this go?
I mean, I guess I'll take it from the lens from the entirely virtual economy, which is kind of where we're sitting, between video games and digital assets purely. I mean, the state of crypto broadly went from, like 6-7 years ago to, about 3 to 400 billion to basically 3 trillion. And so that's very much a proxy as well. As those economies grow in themselves, not just the rise of Bitcoin, but the entire crypto economy, of course, the use of stablecoins grow as well. And I think the very initial use of stablecoins was this on-off ramp as well. It was kind of really, if you think about it, the bridge to the real world. Not just as an RWA, but literally, I have assets that are worth something in the digital world that are entirely virtual, so to speak. And now how do I bridge it to I can, buy something in the real world and do that? And that actually, stablecoins really sort of perfected that model at start, and was also.
And I'm right. That has up to now been quite a significant component of the stablecoin.
It certainly has been a significant component for the initial growth, but I think it's much more significant today because the other thing that's also happened, and especially during COVID, we saw this in places with some of our products in places like Philippines and Indonesia. There was basically mass adoption of places where they needed to make virtual income. And virtual income can be made through activities that are done in those digital worlds, right? They used to call it the metaverse. Metaverse is kind of out, but the point is that people are still making money in those environments. They make them in these digital assets, in crypto tokens. They may be, not real. However, they would then trade them out into stablecoins. And then next thing you know, because they have a wallet, they've got a bank account of some form where they would normally get banked because, $5 isn't worth a bank account, but $5 is a lot of money in places like the Philippines. And then what's interesting also is this financial inclusion that actually introduces a form of financial literacy. And I think it's interesting because, for those of us who've been around for a while, I think it's a little bit synonymous of looking at media consumption in the internet back in 1995 and 96, right? The growth is rapid, but in relative media consumption compared to TV and newspapers, it seems very low. And I think with stablecoins and broadly with digital assets, we're kind of at that stage, right? $3 trillion is a big figure, but at the size of the stock market and generally speaking, it's still a tiny, tiny fraction, which I think represents that opportunity. The other thing, of course, is that we think of this also as the asset class of the youth. So it's not just developing, it's also for young people. If you look at South Korea, the majority of people under the age of 30 now exclusively deal in digital assets of some form or fashion. Sometimes they don't even care about stocks, which is why people talk about tokenizing stocks themselves. And so what is that bridge, right? So I think the growth of stablecoins is going to grow not just because of the demand in the physical world, better, faster, cheaper, all the arguments that we're seeing here. Just on the topic of unbanked, I mean, we're used to T+2, sometimes T+7, depending what it is. But in places of these countries, you need, you need it there in the second, because why do we have payroll systems that pay us on a monthly basis? We think that's normal because we've got credit systems around, but in those places, you need to have your payroll on a daily basis, and stablecoins is one of the best use cases for that. So it's growing from there.
Jeremy, we're all obviously now completely used to the idea that artificial intelligence, is not only the adoption of artificial intelligence is not only now pretty well universal, but we're expecting obviously the dramatic acceleration of it in a increasingly short kind of time frame. Can you tell us how stablecoin, what role stablecoin can play there, and how AI will affect stablecoin?
Sure. I'd start with maybe some basic, which is, when we got started working on this almost 13 years ago, the idea that got us very excited was that first, that you could have kind of money as like a native data type on the internet. So you could have digital dollars, just like you have digital music or communications, like kind of basic building blocks, and that it would be programmable. And the programmability idea was through the advent or the proposal of the idea of smart contracts. And 12 years ago, 13 years ago, that wasn't a thing. Now we have very mature computing networks, these blockchain networks that are able to execute code. And what's powerful about it is that these smart contracts are, they're publicly verifiable. So that's really important when you're dealing with transactions amongst unknown counterparties, or, for example, when you're dealing with transactions between an AI agent and another AI agent. And so we now have kind of the computing material to provide a kind of assured, verifiable, cryptographically verifiable way to conduct transactions. And so that's powerful in a whole bunch of things. It's powerful for bringing more financial market infrastructure online and innovations in the way financial services get built and delivered and rendered. But it's particularly important in this growing world of agentic economic activity. And so, right now what we're seeing is this proliferation in new technology standards for basically payment protocols for AI agents, and payment protocols for AI agents that primarily use stablecoins as the actual medium of exchange. If you think about AI agents that are making these high velocity transactions at very low cost to do work or consume data, et cetera, like taking out your Visa card or firing up a bank wire, or it's just completely absurd. And so we need a medium of exchange that can scale down to fractions of a cent, that has the money velocity and speed of the internet, that works openly, globally, interoperably, any software or hardware connected device in the world that may have AI, agentic activity happening on it, being able to transact. And critically, with AI, one of the big concerns is truth, not just hallucinations, but also how do we know who is this AI agent acting on behalf of, and how do I verify that its output and its work is correct? And so what we're really seeing is sort of the next generation of blockchain networks, things like Arc, which Circle's building on, there's other new blockchain networks, are actually being designed specifically for agentic compute. They're designed specifically for the financial and economic activity of a world where 3 years, 5 years from now, one, I think, can reasonably expect that there'll be billions, literally billions of AI agents conducting economic activity in the world continuously on a continuous basis. They need an economic system. They need a financial system. They need a payment system. There is no other alternative, in my view, other than stablecoins to do that right now, and that can keep up with that pace of technological change. And so it's a critical focus for us, but not just us. There's a lot of other folks that are interested in this and contributing to the technical standards to support this upgrade to our digital economic system.
Let's talk about about.
Can I just
Please
just quickly interject? Just because Jeremy was talking about programmability and agentic AI, absolutely, it's going to be huge. The programmable aspect of basically money is actually, I think, the other part that's really revolutionary. The whole DeFi economy comes from the fact that you can actually program money. And I think the parallel, I think of it, is a little bit like open source, right? For the first time in the world, you have a kind of open source money that is basically reserve backed. But what you can now do is create products and services on top of it that weren't accessible before. And when you think about what the internet did in the early days, it provided that toolkit for media. You weren't a media professional, but now you could enter the world of media. You could be a kid, you could be a programmer. You didn't have to come from the world of finance. And I think it's very interesting when you look at the origins of a lot of the people in the crypto world. They don't originally come from finance. They come from many other industries, but they became sort of included in this world of finance. They learned about it, and then they brought their own creativity, their own ideas to the space and say, hey, how about we do this? Or maybe we should do, a prediction market, or maybe we should do sort of something in gaming. They just integrated that. And in a way, previously, because money was kind of locked in sort of traditional systems, only experts could enter. Essentially, you couldn't grow that space. And I think the real incredible added opportunity is by open sourcing money, you're bringing the entire global creativity, which I think is the opportunity for economies as well, to say, you know what? You don't have to have a finance degree, but you can now dabble with this, and then from there you can develop and then actually become more financially literate, just in the same way that we used to call digital literacy a thing.
Totally. This again, helpfully brings us on to the next topic I wanted to discuss, which is the policy environment, and firstly the regulatory environment. And given these extraordinary innovations you're seeing, we had the Genius Act obviously last year, and I wondered, Dan, if you could tell us what, obviously its principal provisions were, reserve, required reserve backing, some sort of certain protections. How is that, from your perspective? How is that working? Is it? Often when you get a significant piece of regulation, it works in some respects, and then you discover that there are whole areas actually which are either over-regulated or under-regulated. What's your sense of the regulatory climate right now, especially in the US?
Sure. So, with respect to the U.S. specifically, I think it's quite early, right? Certainly Genius was a big step forward in terms of establishing some clear rules of the road, but at the same time, there's still a range of rulemakings that regulators need to go through to figure out how to appropriately calibrate the regulatory framework. And then critically, I think the one of the key things is going to be the interaction between regulatory frameworks internationally, and we have seen progress on the international front. Obviously, MiCA in the EU and lots of other jurisdictions introducing their own frameworks. But if you really want to realize the benefits of stablecoins, particularly from a cross-border transactions perspective, and of course, you really need scale to generate a lot of the benefits that we realize could be realized with stablecoins. You need to have effective interoperability, and so I think that's really the next regulatory frontier that folks need to work on. But just kind of stepping back for a minute from the fund's perspective in thinking about global economic growth and stability, the reason why we need these clear regulatory frameworks is a concept that I think it's really important for everyone to keep in mind when thinking about these developments, and that's competition, right? And so one of the reasons why I think there are such exciting potential use cases for stablecoins is the competitive dynamics that they will bring into the traditional financial system. And I don't begin to know exactly what this is going to look like over the next decade and beyond, whether stablecoin issuers will be the dominant provider of mediums of exchange or stores of value, or whether the technological underpinnings that exist in the ecosystem will be absorbed into the traditional financial system. But I think it's critical that we allow this process to play out, because ultimately it's consumers who are going to benefit from the efficiency gains that the market will respond to. And that would also extend, by the way, to the role of currencies generally in the international environment. And so, as we've already heard, as stablecoins create the potential for additional uptake in jurisdictions that have weak fiscal and monetary frameworks, for dollars or for other currencies, that creates a competitive pressure on those countries themselves in order to improve their fiscal and monetary frameworks, which I think is an important element that we shouldn't also lose as we're thinking about concepts like monetary sovereignty.
Yeah. Vera, that's obviously, and talk a little bit also about, you talked in your opening remarks a little bit about, the role of the dollar, but the importance of perhaps of de-dollarization. And I know you've been working on sort of alternative currency-backed stablecoin.
Yes, no, I think that's, thank you, and that's a very good segue. So that one of the biggest fries, and just to be clear, stablecoin is not crypto, right? At least fiat-based stablecoin, which is backed by some liquid currencies, is what we're talking about here. And I think if you look at the African continent, we have over 50 countries. We have the African Continental Free Trade Area Agreement. Countries need to trade. We have a lot of capital controls on the continent. So it's very difficult to move around if you're trading. And essentially part of that is about, weak fiscal policies, deficits, debts, and also monetary policy that sometimes is not always appropriately anchored. And what you can do with stablecoins, and what we're trying to do actually, a group of us, is design an African stablecoin platform, which essentially is backed by the SDRs. And so sort of the underlying assets will become, still fiat currencies, US treasuries, but then it begins to mirror Africa's trade with the rest of the world. And if you take, for example, one of the advantages, we're beginning to trade a lot in renminbis, right? Today, we have to go through the dollar, the intermediation cost. And so if you can do a stablecoin platform that has, the SDRs, of course, have the 7 largest currencies of the world, then you begin to, it does not impact on monetary policy, because today what we have, if you're in Nigeria, the 59 billion is mostly USDCs. And so there is already a monetary policy dislocation that is happening, because even if the Nigerians are mostly buying, I was just talking with the Bank of Industry, they are mostly purchasing Brazilian machinery for agriculture, but they're switching through the dollar and or Chinese machinery. And essentially what this kind of system will do is, one, it will push monetary policy to anchor better on inflation, push fiscal policy, hopefully, to be slightly more prudent. And then what happens is that you don't have the sort of dollar domination, which is what I think everybody's afraid of. And it is true today, 75% of the stablecoin environment is with USDCs, which are basically dollar denominated. But the good news about it is also, I want to say for Africa at least, that the other part is not all fun and games. I think there are some drawbacks. One of the biggest drawbacks, particularly more in the crypto world, is a little bit about transparency, AMLs, and those kinds of safeties. I think with blockchain, we are able now to build in sort of truths to the system. In Africa, we have talked for the last another 15 years about illicit financial flows and the fact that, the mining companies take out the resources and we cannot appropriately fiscalize that. This is another way of doing that in a more appropriate way and actually really following the payments and the system. So I think for us, it actually is a governance enhancer. It's a fiscal policy enhancer, and well done, it's a monetary policy disciplinary tool.
I've got a few more questions from me, but so please, we'll open it up to questions from the floor in a second. Jeremy, one very lively debate that's going on right now in the context of regulatory policy environment is the question of interest-bearing stablecoin, of interest payment on stablecoin. This was been actually here at the forum at the meeting this week, a topic of lively debate with, perhaps not surprisingly, banks expressing great concern about the possibility of interest being paid on stablecoins. I think I saw Brian Moynihan, Bank of America CEO, saying that would lead to a massive flight of bank deposits into stablecoin. What's your, and we can explore the implications of that, sort of the monetary policy implications and other things of that, but what's your, where are you on that, and what do you think? Do you think he's right that you would see a very dramatic shift out of traditional bank deposits if that were to happen?
So there are a few, I think, key issues here. I think there's the sort of the law and policy issue. There's the actual kind of data about what's here, and then kind of how does this go forward. And I think embedded in all of this is sort of, in my view, sort of taking a first principles approach to how we're designing an internet native financial system, which is sort of how we think about things. So maybe just to touch on each of these. I think the first is we have a law, the Genius Act, in the United States, and we have laws in Europe, MiCA. We have laws in Japan for stablecoins. We now have laws in the UAE, Hong Kong, Singapore imminently, and in many other places. In every single one of these jurisdictions, stablecoins are prohibited from paying interest. That is because stablecoins, payment stablecoins, and in fact, the law in the United States defines a payment stablecoin as a cash instrument that is a payment token that is used as a form of payment and settlement, right? This is the fundamental definition, and I think it's the correct definition, and that's the work of the FSB, that's the work of the G20, that's the work of central bankers who've looked at this and said, we see this as a payment system innovation. This needs to have the safeguards of kind of cash level money. And really that was the regulatory design that came out of a lot of work, 5 years of work. That work went into the development of the stablecoin bill, which eventually became known as the Genius Act in the US. And that is the law. And I think that's very good, and I think that's the right law. Now, there's sort of a second piece, which is, stablecoin issuers such as Circle are prohibited from paying interest. But we generate income. We make money from reserves and other revenue sources, and we build partnerships with lots of companies. We have a partnership with Coinbase. We have partnerships with Binance. We have partnerships with Visa. We have partnerships with so many different companies. And we have economic arrangements with these firms, and they may decide, based on income that they generate from us, that they want to incentivize people to use stablecoins, which are so-called rewards. I think the discussion has been, really banks are not happy that, companies that are involved in promoting the adoption and use of stablecoins are paying rewards. They're saying, hey, isn't this just a way to provide a substitution for a bank deposit? And isn't that going to suck all the deposit base away from banks? It's going to basically undermine the ability for banks to have money to actually have a base in order to give credit. It's going to draw away credit from the real economy. And when we're in a stress condition, the economy is going to implode and we're going to have no credit and it's going to be a huge recession. I mean, that's the kind of, reductio ad absurdum kind of logic that flows through.
Is it absurd?
It's totally absurd in my view. And it's totally absurd for a couple of reasons. I think the first is that, rewards around financial products exist. Those rewards around financial products exist in every balance that you have with a credit card that you use. They exist around so many other financial products and services that we have. And these rewards are actually very important. They help with stickiness, they help with customer traction, et cetera. They are not themselves like these huge monetary policy dampeners. The second is just the historical fact, which is that this is exactly what was said when government money market funds emerged. The exact same arguments were made. Government money market funds are going to draw away all the deposit base, and as that happens, there will not be lending. And so we have, I don't know what the aggregates are now, it's been around $11 trillion of dollar money market funds that grew in various different circumstances, but that has not stopped the ability for lending to happen. The other is that lending itself is moving away from the risk-taking of banks. A huge amount of lending is moving towards private credit. Last night, a very important capital markets participant was pointing out that the vast majority of GDP growth in the United States, if you look at through many, many cycles, the vast majority of GDP growth was funded by capital market formation around junk bonds. So private credit issuing junk bonds, capitalizing the build out of the American technology advancements, not bank credit. Now, I'm jumping around on a lot of topics here, I realize, but I think the bottom line from my perspective is we want stablecoin money to be cash instrument money, prudentially supervised, very, very safe money. And then I think what we want to do is we want to build models for lending that build on top of stablecoins. And that's, DeFi is an early example of that, where people are borrowing and lending these. And I believe we can create very, very efficient credit delivery systems built on these sort of digital cash type forms of money. And these credit delivery systems actually can be safer, more transparent, more efficient, more inclusive, and more globally available than what we have with bank credit today. And so this is a change in the architecture of the financial system. It will play out over decades. And I think we need to kind of preserve that structure.
Vera, do you want to weigh on this?
Yeah, I want to come in quickly. In Africa, again, and I think it is true for some developing countries, a lot of our bank deposits are government paper and or short-term deposits, so banks don't lend as much. And so there's a huge illiquidity problem on the continent. And what we're hoping that stablecoins will do is provide a little bit more liquidity and velocity of money for that businesses to happen. So it's almost like your junk bond sort of releasing the economy and deepening. I think we heard today, even in Europe, that there is constraints in building capital markets. One of the constraints for building capital markets on the continent is precisely this liquidity in the system, which stablecoins begins to fix. And so, but I think actually, one of the reasons why stablecoin has come so fast and its huge adoption is because the banks themselves took too long to get to central bank digital currencies that everybody has been waiting for as long. And my sense is over time, what we will see is maybe a closer relationship between the circles of the world and the banking system. I think there is, because again, this is really a payment system. There is still going to be a lot of the monetary policy functions that remain with central banks. And where we should be, it's not saying, one is going to take away the other. It's how are we going to create a system? I think the Genius Act, MICA, and everybody else is beginning to say, and that's why we're saying it's a payments settlement system. But then there's the whole collateral management, central depository systems that the banks will still continue to do. And I think we do need to find, where is that bridge so that the rails sort of collide. I think that's the argument.
Maybe just as a closing statement to this argument also is that, the liquidity isn't just domestic, of course, the liquidity is global. Just how the internet distributed information to the world to consume, now you can do commerce with literally the entire world. There are about 200 to 300 million people around the world that have stable coins that are US dollar denominated. Every American, European, Asian business can now transact with them relatively stably and safely. Right? They don't have to worry about local currency. They don't even have to worry about, those people can't sign up with a PayPal or a Venmo account, right? They don't have a way of having a credit card, and you can now do business with them, right? So both ways, right? So I think that's the added dimension as well that adds much more liquidity to the entire space.
Thank you. We have time for some questions, please. This is your opportunity to talk to some of these experts. Gentleman in the front, would you stand up, please, and identify yourself? And you've got a microphone there.
Sure. My name is Pierre Grameni. I'm the Managing Director of the European Stability Mechanism, so that's the lender of last resort of Europe. I would like to congratulate all the speakers and you for the very insightful discussion. And I have a question to which I don't have the answer, but what struck me most from all the points was this issue of instant payment, instant settling, and liquidity. And if I remember correctly, the money supply is the amount of money there and the velocity at which it circulates. So my question is, to which I don't have the answer, but it would be important to think of it, would be the following. With all these instant payments and settlements, don't we have a money supply that grows tremendously? And if it grows tremendously because of the velocity, will that have an impact on inflation, on monetary policy?
Okay. I'm very glad you asked that question, because we were going to come on to monetary policy, PV equals M, or whatever. So go on. Yeah, Jeremy, you want to answer that?
I'll just give my quick take. I actually think it's the opposite. I actually think that I call it the new physics of money. And so basically, just like the marginal cost of storing and moving a piece of data is effectively zero. We can now move infinite data at the speed of the internet at zero cost, or the marginal cost of publishing software in the world is zero. And now with AI producing software, the marginal cost of actually producing software is effectively zero. So we have these collapsing marginal costs. And on these networks, the marginal cost of storing and moving value of any form, whether it's a digital dollar or a tokenized bond, effectively goes close to zero. Now, there may be intermediary tasks that introduce costs, but fundamentally, the physics of money becomes the physics of the internet. And what that means is actually you need a smaller monetary base in order to achieve a dramatically higher amount of economic velocity. And so I actually think this is a prudential and a monetary theory question. It is unresolved. I think about this a lot, which is hypervelocity of money is potentially a very good thing in terms of money velocity kind of as a mechanism to transmit economic activity could be a real driver and growth enabler. I think risk supervision in that is very different, so that's an unknown, how to do risk supervision in something like that. But I actually think the monetary base is lower. But I do think over the long run, this will affect how interest rate policy setting happens. So interest rates are designed to affect money multipliers creating money velocity. So I actually think this will change the calculus that central banks have to use as they think about the interest rate setting mechanism because of the nature of this new physics of money as I think about it. These things need to be studied, obviously, by perhaps folks like you and your team. Our chief economist thinks about this as well. And obviously, we're still small, but growing rapidly, so we are thinking about it a lot.
Dan, the impact of all this on monetary policy must be of great interest to the International Monetary Fund.
Absolutely. So we're one of these groups that are working on these issues that Jeremy's quite right, need to continue to be studied. And just to pick up on a few of the points that Jeremy made, in terms of the interplay between the velocity of money and inflation, the classic equations, I would say, are really designed to measure the balance of demand and supply for money. And what's interesting about the impact of digital assets on the velocity of money is it's really more of a supply-driven function increase in the velocity rather than a demand-driven increase, which if there was an imbalance between demand, or if demand was higher than supply, that's where you would tend to see inflation. And so I actually think Jeremy could quite be right that actually we'll ultimately end up with a smaller monetary base and not have significant inflationary pressures as a result. More generally, in terms of the operation of monetary policy, look, I think it's very difficult to say today where things are going. So much will depend on what happens across the entire ecosystem, how banks compete with stablecoins, and how stablecoins more generally get integrated into the financial system. But I would observe that that for central banks, actually updating their operational frameworks is an exercise that they go through quite regularly. In fact, in the United States and in Europe, over the last decade, we've had fundamental transformations over the way that the central bank actually conducts monetary policy from an operational perspective. And so this is something that central banks, are already thinking about and will continue to think about, and we shouldn't, wed ourselves to a particular framework that's frozen in time.
We have time for one more question, if anyone...
I would just answer very quickly that essentially for us in the emerging market world, it is actually about efficiency. I think when we talk about Europe, we're talking about accelerating real-time gross settlements. That's what we're trying to do. So I don't think it's contradictory. And so I agree with you. It's a little bit. At least Africa has been 5 days of settlements, whereas Europe is 1 hour. And so you're saying, should we stay at 5 days because? And I think we're hurrying to efficiency.
So just because there is interest in another question, very quickly, Miss, if you would stand up, please, and identify yourself.
Hi, everyone. I'm Drishti, a global shaper from India and an entrepreneur. I just have 2 questions. We know the stablecoins have proved the utility as a settlement and liquidity instrument in the tokenized real estate market, but I wanted to understand how viable it is in terms of commodity tokenization, especially when it is volatile, and how does it work in terms of hedging when commodity-backed assets are relying on stablecoins?
All right, we were so short of time, I'm only going to allow one of you to answer, whoever wants to answer that question.
I can take that.
Jeremy.
Yeah. I mean, basically, tokenization of other assets, whether it's a gold or oil or some other commodity, is happening. But you need to marry those with stablecoins for actual cash settlement, and you need to marry those with traditional market structures that people use for hedging, so options and derivatives markets, et cetera. And so what we've seen is an explosion in on-chain markets that are all stablecoin based, markets like Hyperliquid, where basically people are building tokenized instruments for basically providing derivatives on every single form of commodity and asset that's in the world. And stablecoins are the collateral, the relative margin, and the liquidity for that. And so I actually think market infrastructure to support tokenized commodities is maturing very, very fast, and stablecoins play a key role in supporting that.
We are unfortunately out of time. Thank you all very much. The title of this session was Where Are We on Stablecoins? I think our excellent panel has answered that question, both in terms of where we are now, what the potential is, what the various challenges are, and I think generally speaking, a very good overview of what is a rapidly evolving subject. So, ladies and gentlemen, please join me in thanking the panel.